A very good afternoon, a very good morning. Welcome to HYCM's workshop. Oh, hang on a minute. I'm just going to share the other screen. Welcome to HYCM's workshop with myself, Giles Cochran. Very warm welcome to you. Glad you could make it. And if you could just let me know you can see my screen and hear my voice okay, that would be great. Just so I know you're coming through loud and clear, just fill in the chat box or the question box. That's super. Thank you, Setley. Much appreciated. That's very good. Yeah, great. Thanks, guys. Right, okay. Now, before we get stuck into the session today, don't forget to look at different entries, exits. This is from a trading educational perspective. The idea is you look over my shoulder, someone with a professional trading background, and you go to see how about make trading decisions. And the key principle in trading is this. What we're always looking to do is we're looking to pair strength against weakness. Now, in this illustration, as I've shared a few times before, but it's so crucial, we would expect the relatively stronger arm to overpower that relatively weaker arm. The t-shirt that has the black, and there's a t-shirt with the white, and we'd expect the black t-shirt arm to overpower the white t-shirt arm each time, because that arm is clearly stronger than the other. So if you had to guess, which arm would you expect to win the arm wrestle? Well, you clearly say, I'd expect the strong arm to win the arm wrestle because it's more powerful than the weaker arm. Strength against weakness. Now, this idea is always what we're trying to do when we're trading currency pairs. And this is so crucial to understand. Once you understand this, you will really grasp something very important about FX trading. So we're looking to pair a strong currency against a weak currency. That way, we have the greatest probability of understanding the direction. So we'd expect the strong currency to overpower the weak currency. Now, how do you know which currency is going to be strong and which currency is going to be weak? Well, it's quite simple. Central banks have a mandate to control inflation levels and to control the exchange rate for their exporter and importers. They want to see stability. So central banks communicate to markets what they expect interest rates to be. Now, when interest rates rise, currency rise. Now, think about it like this. If the interest rates are 6% in New Zealand, but if they're 1% in Europe, and imagine you've got £10 million sat in a bank account, where do you want that £10 million? Do you want it sat in a European bank account where it's earning 1% interest, or would you like it in a New Zealand bank account where it's earning 6% interest? Well, I know where you want your money to be. You would want your money to be where it gains the most interest. That's why when a central bank increases its interest rates, it attracts inflows into that country. So people would sell their euros and they would buy their New Zealand dollars. So the value of the New Zealand dollar goes up as the currency becomes more and more in demand. Now, I'm going to walk you through that today, how we're going to be doing this with one currency pair after the decision we've just had, the RBNZ rate decision, which happened last night. I'm just going to go through to my other screens and I'm going to walk us through this step by step. And you can take this principle and you can use this principle over and over again because this principle is essentially the same principle that I use day in, day out in the markets. So let's go to my other screen and we'll just get rid of that for now. And this is what I want to show you. Okay, so before we get stuck into it properly, let me just unpick with you the decision that happened. So we'll look at the decision, the RBNZ decision that happened last night. I'm just going to go through This is the financial source terminal. I am an analyst alongside my role as consultant for HYCM with Financial Source. And so this is one of the terminal, and I do lots of daily webinars here. Don't forget as well that if you're not following me on Twitter, this is my Twitter handle here at Giles Cochran CCA, and you can follow me here. I'll just put it in the chat box. So if you're not following me, if you follow me here, because I often give, like, I gave some breaking news on this as soon as I woke up this morning. That is my Twitter handle there. And you can see here that I gave some breaking news, what this meant. You can just see here, RBNZ acts to restrain inflation by hiking by 50 basis and raising the official cash rate to nearly 4%. Will other central blah, blah, blah. Aussie, New Zealand dollar sell bias emerges. Okay, I gave a little outlook there. Now I'm going to talk you through the rationale for that, but do follow me on Twitter because I do update and do breaking news there. Now it's not obviously trading advice, but it's a sort of from educational perspective. So just as long as you know that, like, I'm not updating it all the time, and if the sentiment changes, I'm just giving basic guidance and analysis, right? From a professional perspective, which all professionals are constantly doing. Right, here we go. Here we go. So the New Zealand cash rate. Let's just get that out. Oh, somebody decided to go. Oh, sorry about this. Bear with me 1 minute. I just can't. I'll look at it a different way. Here we go. Right, I don't know what that was. It wasn't that. Okay. So let's just run through what's exactly going on here. The RBNZ hiked interest rates by 50 basis points to 2%. Now that was all totally expected. Now remember, there was no surprise there at all. And when you have a carry trading, Aaron, exactly. And when you have a central bank do what the market's expecting, that's nothing. Okay, no surprise, fine. But the surprise was this second part. It raises its OCR forecasts. Now, all the OCR forecast is its official cash rate forecast. So that's when the central bank looks into the future and tries to, remember what I said, a central bank wants to have smooth currency exchange rates. So it tells the market what it envisage its intentions in the future. And its intentions have changed. So you can see that now it sees the official cash rate. That's just the Reserve Bank of New Zealand's term for interest rate. They see their interest rate now at 2.68% in September and 3.88% in June 2023. And they see the official cash rate nearly 4% for September 2023. So in other words, between now and September 2023, the RBNZ see a space for 200 basis points of rate hikes. Is that 8 25 basis points, 4 50 basis points? But you see, they have revised higher their official cash rate. So yes, they hiked as expected, but the surprise was we expect to hike more quickly and at a greater rate than we previously expected. So that's why the New Zealand US dollar immediately moved higher by 55 points. That's what was going on there. Now, a couple of things to note. This is the statistics here, and you can see, look, by December 2022, this is from the RBNZ's rate statement, they're expecting the official cash rate to be 3.4%. So that tells us now it's currently at 2%. So then get September at 2.7%, then they could easily be looking at another 50 basis point hike in July. That's their next rate meeting. Okay, and then what, another 50 basis point around August, October. So they really are expecting interest rate hikes. Remember what I said at the start? Then that means that investors are attracted to buy New Zealand dollars. Right, you're getting the idea, right? So that's what's going on. That's given us that New Zealand dollar upside bias. Aha, but here's the slight catch with this. Now, you might have heard the expression, the market remains rational, it can remain irrational longer than you can remain solvent. Now, if you remember, going back, if you look here, this is my blog, blog.hycmlab.com. If you're not following along this blog, let me just recommend that you do. Please follow it along. I'm on that. Okay. Now, if you look, the turn of last year, look now. Do you see? In November, end of November 2021, I was making the case for New Zealand dollar Japanese yen longs, and I was basically saying, you know, the RBNZ had the highest cash rate among major central banks and looks set to increase rates further. The RBNZ see the official cash rate at 0.94% in March 2022, 1.6% December 2022, blah, blah, blah. So at the time, the RBNZ were the most hawkish central bank, and this is going back to November 2021. Now, this is what is the health warning with this, is as follows. Because even though the RBNZ was the most hawkish central bank in November 2021, this is the basket of New Zealand dollar. Look what happened to the New Zealand dollar. Do you see the New Zealand dollar actually fell lower? Now, eventually it moved higher, and I was long New Zealand dollar Japanese yen and made a very nice profit on that trade, right? But there was a time when I had to endure, that's never nice when you're trading, is drawdown. But I knew to hold because I was confident that the analysis was correct and that eventually the monetary policy would play out. And the New Zealand dollar rallied sharply higher. But notice how the New Zealand dollar has now fallen a bit lower. Now, I'll tell you what can help you here. If you just look at this basket, you can see here on the daily chart, we're seeing a potential break of that near-term trend line, okay? So we've got a little potential break of that near-term trend line. And on the weekly chart, what you can see is they've got a Harami inside bar break to the upside. So prices are trying to find support around this key support level here. So that is looking supportive for the New Zealand. But just remember, just because the central bank has a hawkish bias, okay, that doesn't automatically and definitively mean that it can't go in the opposite direction. So that's the health warning that comes with this. And that's that old expression, markets can remain irrational longer than you can remain solvent. So that's why it's always absolutely crucial to define and limit risk. Okay. Right, with all that being said, let's now go to the Aussie New Zealand dollar pair. I'll show you some more things here. So first of all, what we can see is that the Aussie New Zealand dollar pair was moving higher in line with its bond yield differentials. Now, what's a yield differential? Now, the yield differential is simply the difference in the Australian 10-year bond and the New Zealand 10-year bond. Can you see that? You see how the currency tracks the bond yield spread very closely? Well, when you notice, whenever there's a big divergence between the yield spread and the price, one has to catch up to the other. So you can see here, going back, hang on. Let me just, right, you see here, I'm sorry, my screen has just gone. just going to reload the chart. Sorry, it's just when something it loads funny, and it's just something that's better. Right. Okay, we'll go back to it. View. Right. So that bond yield spread gives you a good indication of where price is going to go. And you see, when you get a divergence between the bond yield spread, okay, the price will either have to catch up to the bond yield spread, or the bond yield spread will have to catch up to the price. So you can see here in September 21, do you see how the price is moving lower, but the bond yield spread is moving higher, and that ultimately brings price higher. So after the RBNZ rate decision, what do you notice? You see that the bond yield spread has suddenly taken a sharp dive lower. Okay, so that's indicating that the outlook has suddenly got better for New Zealand relative to Australia in terms of interest rate differentials. In other words, the New Zealand dollar should gain against the Australian dollar. So that means that as this breaks lower, we can expect any retracements up to that level will be reasonable to find sellers looking for a move back down to that 1.0850 region. So that's what we'd expect. Also notice that's a Harari inside bar, false break, fall. So any moves back up to 1.0970, 1.0960, expect to find sellers. So I would be selling any retracements back up to that region, looking ultimately for a move back down to this 10850 region. Now, if you look at the Aussie New Zealand dollar pair on the monthly chart, you can see, look, that the Aussie New Zealand dollar is trying to put in a bearish reversal candlestick, okay? It's trying to put a bearish reversal candlestick in that area, okay? So that's what we're looking at there. And if we get that bearish close within the body of the April candle, then that's opening up a potential retest back down to that 1.0860, 1.0850 region, just marked on the chart, also the other side of the 100 exponential moving average. Now that's what we can reasonably expect. Now, where would you put your stops? Stops can be anchored either just above that 1.100 region or above that 1.1088 region. But what I'm using this trend line to define and limit my risk. So in other words, as long as I stay closing below that trend line, I'll stay with the trade. If I move back higher above that trend line, I'll exit the trade and maybe consider entering a different time. This is called a trend, a 1, 2, 3 trend reversal. You see you've got 1, 2, that's not a third touch. So 1, 2 touch. This is only a potential trend line. But if you notice how price moved and nuzzled against that trend line across the RBNZ decision, that's typical as technical traders just looking for obvious turning points in the market. That's your turning point. With that break, that is now good enough for me to be the first sign of a potential trend reversal. Okay, so we now have potential trend reversal. 1, any rejection higher from these levels. 2 will be significant, and then take out these lows. That is the trend's changed. Okay, so that's what we're looking at here. Using the bond yield spread, if the bond yield spread suddenly surges higher, think again, but I'm expecting the bond yield spread to move lower. Why? Because we're expecting more aggressive interest rate hikes from the RBNZ as we move forward. Now, all outlooks have risks, and this is no exception. The main risks with this outlook is that the New Zealand economy starts to slow down. Governor Orr said after the meeting that he was confident New Zealand households would be able to manage higher interest rates. But what happens if they can't? What happens if they have to slow down interest rates? Then we could see that yield differential dissipate. Similarly, maybe the RBA suddenly decide they need to be more aggressive. That could negate this outlook. So there are significant risks to this outlook. However, at the moment, there is a clear sell bias on the Aussie New Zealand dollar pair, and nice trend line break. Any retracements higher, expect sellers. You can also look for this from any sort of technical system that you have. You can now look for Aussie New Zealand dollar shorts. Okay, can you find a way in? Have you got a technical system? What could you do? how would you analyze this currency pair? You know, this is, you can see hooking action just above the Bollinger Bands. Okay, that's looking like it might move lower. You know, are you looking at that? Looking on the daily chart, you can see that maybe the green line is beginning to pop through the yellow line. And if the green line goes through the yellow line, then that can set off some pretty large falls. You can see here the green through the yellow, hundreds of points falls. Green through the yellow, still a couple of 100 points. You know, when you get green through the yellow there, we could see, you know, a couple of 100-point falls. You see the kind of thing you can do. Okay, folks, that is how professionals go about understanding and trading interest rate meetings. That's how it's done. So you've seen behind the scenes. Just going to go and see if there's any questions you got, anything you'd like to say. Next week we've got the bank calendar meeting, so we'll do it all again next week. But next week, come along and we'll get ready ahead of the bank calendar meeting, and I'll show you what you could expect. Yeah, good question, Aaron. Any expectations for FOMC minutes? That's a great question. Now, the problem the Fed have, let me just explain the context, and then I'll explain the expectations. Okay. Great, thanks for bringing that up, Aaron. Now, the problem the Federal Reserve have is this: as stocks fall, eventually the Fed will want to stop hiking interest rates to support the economy, the US economy. Now, usually when the S&P 500 has corrected more than 24%, there tends to be a US recession. So that means that once we get to sort of that 24% level correction in the S&P 500, which is around that 360, 400 region I've marked on the screen, typically that leads to a US recession. But what's the problem for the Fed? They can't stop hiking interest rates right now because inflation is so high. So the Fed are stuck. Which one are they going to do? Are they going to hike interest rates to control inflation, or if a recession's coming, will they pause in order to allow the economy to recover? It's a very difficult conundrum they have to try to solve, and they're trying to get what's called a soft landing. And the soft landing is when they can basically hike interest rates to control inflation, but without completely destroying growth. That's their plan. Now, the FOMC minutes, Aaron, are like largely kind of, the market sometimes will focus in on them. They are historical. We've had the FOMC meeting. So these are kind of like, you know, old hat. We did notice since the FOMC minutes that the Federal Reserve speakers, a series of them have been very, very hawkish. So I can't see anything being more hawkish than they already are. So I'm not expecting anything from the minutes, but sometimes, Aaron, the market forgets that these minutes were from weeks ago, and they can focus in on something. So it's a key risk, particularly for equity markets and particularly for the dollar at the moment. So just looking at the dollar yen, for instance, I know I'm sort of hedging my bets, but it's because it really is it's a bit of a lottery. So it's mainly, the main perspective I have on this is it's a risk event for the dollar. Now you can see here, the dollar yen has pushed lower. And what's happening here is it's 10-year yields that moves, sorry, I meant to be looking at the dollar yen. That would help, wouldn't it? Right, if you look at the dollar yen, see it's pushed lower through that key support level. Now, the dollar yen basically tracks the US 10-year yield. See how close that is? And that's just because the Bank of Japan is flat, they've been the same. So basically, dollar yen just tracks the US 10-year yields. So as US 10-year yields keep moving lower, right, that is on that growth perspective. So this is a rejection of these prices, but the key decider of this, Aaron, is going to be the US core PCE data on Friday. If we see a surprise miss on Friday, expect dollar yen to really drop lower and expect euro US dollar to surge higher. Okay, so that's what we're looking for. If we get a miss on the US core PCE. The FOMC minutes today, I'm not expecting anything because the Fed's been very hawkish since the minutes, and they're quite historical. They're quite a few weeks ago. So they shouldn't move markets, but you're quite right to bring them up because sometimes they can. Sometimes the market reacts like, you know, we've just seen this for the first time, which they've just seen it for the first time, but it is historical. All right, I hope some of that makes sense. So mainly it is risk for the dollar and it is a risk, but we have that big narrative. Is the Fed going to tackle inflation at the risk of growth slowing? That's kind of the big outlook. I hope that helps. Yeah, and thank you for your question. That was very good. Okay, folks, don't forget, back on Monday, and on Monday we'll be getting ready for the next coming week. We'll be looking for the clear opportunities that we see, and also that's on Monday, and next week we'll be looking at the Bank of Canada interest rate decision on Wednesday. So come along for that, and we'll get ourselves nice and ready for that. Don't forget to follow me along at Twitter if you're not already doing so. Otherwise, thank you very much for your time, and an absolute pleasure. Take care, everyone, now. Goodbye.